Good afternoon and welcome to Navigate by the Stars, but Steer into the Swell. Does that sound like should be a concert, Jake? Some kind of Venice Symphony or something?
Oh, I couldn't agree with you more. That'd be a perfect name for it.
So this is a different production and a different presentation than what you've been seeing with Coffee with Forethought. So thank you, Jake and Joel, for doing the lion's share of that work. The purpose of this webinar and the work that we've been doing really for the last 3 to 6 months is our strategic allocation. So every year we revisit our long-term strategic asset allocation for our clients. There's a bunch of components that go into that we'll be talking about momentarily, but it's designed to be those stars, the things that you navigate long term. It's not the kind of thing that we're trying to manipulate short term. It's what do we see as the big global themes that are going to really be the wave that pulls us as far as big picture goes. We're also going to talk at the latter part of our webinar today, Jake, about what's going on tactically. What are we going to be doing short term? This one's going to be a little bit longer than what you're used to with Coffee with Forethought. It's going to be more in the line of our economic review. So we'll be going about an hour, but we'll see how long you and I pontificate. So sound good? So
Yeah, that
let's
sounds great,
launch in.
Scott.
First, some introductions. Here you see the picture of Jake and I, but you can also see us live, so you don't need to really look at that. But let me just reintroduce Jake McFarland to you. He's not only a CFA, but also a CFP, been with us for over 5 years now. And you've only worked, that's not really true. You had a couple of jobs before that in the financial services industry, but the majority of the time you've worked with FourThought. And what that means is that you've sat in with me and designed with me the curriculum for our new advisors, but also the books that we've recommended and we've read over the last 40 years to kind of influence our thinking. So I like to say that you're trained in the FourThought way of skepticism, humility. We're always worried, but we're optimistic. So, Jake, as I introduce you and talk about your background, what would you say are some of the most influential authors in your philosophical approach to investing? Now, I didn't prime you with this, so I'm catching you cold. So,
Yeah, you are definitely catching me cold, but that's okay. A book that really informs our view on how we think of companies is one that's called Good to Great, right? And it looks at it really
Jim
informs more of
Collins.
yeah, Jim Collins, of course. It informs really more of our bottom up stock selection approach. So that one's really good, and of course, getting into like the entire Benjamin Graham sort of library there on truly picking stocks. I think as we take a step back and look at more of our strategic asset allocation, right? Yeah, I don't know if there's a traditional published book that really speaks to me. A lot of it is more academic papers and sort of data that looks back in history at different time series to sort of show risks return of different asset classes. So I know we're going to talk about a lot of strategic views here, Scott. Any that kind of speak to you and sort of have helped you inform how you view your strategic versus tactical asset allocation?
Yeah, so for me, I went through a period of time where I was studying to become a deacon at church, while at the same time, this whole behavioral finance genre came into fruition through Danny Kahneman and Thinking Fast and Thinking Slow. And what I found is that there are these ancient principles about the way we think and some of the biases and the ways in which our minds get us into trouble that perfectly overlap with investor behavior. And so those types of books, Daniel Ariely and others like that, I went to his class in Duke, by the way. Fascinating. Nassim Taleb has been one of my most influential authors. He had Fooled by Randomness, Black Swan, Skin in the Game, and some others. And what he taught me is that, especially Fooled by Randomness, is that we attribute mentally a lot of things to our smarts and our ability to read patterns and stuff. and randomness is all over the place. And so it's really about a lot of humility. The other thing that his influence is directly, you can see it directly in every conversation we have, is that when you're meeting with the FourThought planner, we actively talk about being prepared for the flood. And philosophically, what that means, obviously, is its connection to the book of Genesis, and that informs us that there can be events that happen. Nassim Taleb calls it what is it? It's basically it's the black swan. It's all you see is not all that there is, or what you see is not all that there is. That's why it's not a bumper sticker, but it's one of the things he says over and over again, that there are things happening that have never happened before. And if you're looking for things that you recognize, you'll miss out on a lot of the things that are actually going on. And we're going to talk about that today, because this whole idea of forecasting is tough business. But before we do that, Jake, why don't you walk us through a couple of our required disclosures?
Yeah, and as always, the material that we discuss here today, it's not a recommendation to buy or sell any security. It's really, not advice. If you'd like to have a portfolio review or have any questions answered on your personal portfolio, please contact your financial planner to review there. And then also, we're going to have live Q&A as well. So at the end of the presentation, we'll go over all the questions. If you have any questions or topics that you'd like us to dig into a little bit deeper, use that Q&A box at the bottom of the screen, and we'll make sure to get to them.
And why don't you walk us through kind of the big picture agenda, first of all?
Yeah, absolutely. The theme for our conversation today is stars, swells, and tsunamis. So first off, everyone take some time, try to say that 5 times fast, and let us know how you do. Each first quarter economic review, we like to take a step back and sort of broaden the lens and revisit how we think about asset allocation. At a high level, we break that process into 3 elements, which we'll get into. And the first one are the stars. This is a mapping and represents our long-term strategic approach. These are the time-tested principles that form our North Star. And when markets get choppy or visibility fades, there's fog out there, we can look up and rely on the stars to keep us oriented and keep us on course. And the second component of it would be the swells. These reflect our shorter term sort of tactical decision. The stars will still guide our direction, but the swells, which would be like the currents or the waves beneath the surface, they help inform where we want to lean in and where we want to pull back, which assets we want to move with or move against.
So a good way of thinking about that, Jake, is you have your navigational buoy that you're heading to, but as a sailboat, you just don't go straight there. You got to tack back and forth. And we find that that's helpful from an investment perspective. We might think that equities long-term are really a great place to go, but there'll be a point where they're overvalued, and we may want to tack a little bit to the left, knowing that we still overall long-term like them. Go ahead. Sorry about that.
Yeah, and it sounds counterintuitive, right? Like the shortest distance between point A and point B is a straight line, but it's often not the smartest way to go as well. And I think that's exactly to your point there, Scott. And then the last component of it would be the tsunamis or the rogue waves. As you mentioned, Scott, these black swan events, they're rare and they're unpredictable, but they're extremely damaging. We don't expect them often, but prudent portfolio construction means being prepared for them when they do arrive.
And we are going to talk about some of the tsunamis that we're watching. But as you just said, and I've been doing this for 40 years now, and I've seen my share of tsunamis, and you never predict them. I mean, everybody was so focused on Y2K when that was going on. You guys probably don't remember it, but the whole thought was all of our computers were going to crash. And nobody saw Enron and MCI WorldCom coming. And nobody saw 9/11 coming. So we had a tsunami, but it wasn't what you expected. And so we're going to talk about some tsunamis here, but we're going to couch it with knowing that we can't predict the future.
Yeah, so Scott, let's get into our asset allocation approach. And for those who don't know, asset allocation, what that is, it's just the percent of a portfolio that's invested in different asset classes. The most common example is called the 60/40 portfolio. And that means you have 60% of your portfolio allocated to stocks or equities, and you have 40% allocated to bonds. Now, however, when we do some analysis for our asset allocation, we look deeper than just the high level of stocks and bonds. For example, one could consider within that equity portion US stocks, large cap and small cap companies, international stocks, both developed and emerging markets. And what's important is that each of these groups have different risk and return dynamics that we have to consider. Studies on pension funds and balanced portfolios shows us that long-term asset allocation mix explains most of the variabilities and returns over time. To put that a little bit differently, asset allocation sets the direction and determines most of the ride, whereas manager or stock picking can add value at the margins, but they don't usually change the ocean that you're sailing in. And so, with that framework, one of the most enduring ideas in investing is that diversification is the only free lunch. And what that means is that in most areas of finance and investing, if you want to improve your returns, you are required to take on more risk. However, diversification allows us to reduce the risk without giving up a lot of expected return. Combining assets that behave differently are sort of act like pistons in an engine there. And across market environments, we can sort of smooth the volatility a little bit and reduce the impact of one single outcome on one single economy. And that helps us improve consistency over time. So if you're a client, you're already familiar with our investment process whereby at the stock level or at the security level, our approach is bottom up and cash flow driven. What that means is that we focus on identifying exceptional businesses with very durable competitive advantages and strong cash flow generation. When it comes to setting our asset allocation policy, though, we are in complementing that bottom up framework. We work with a lot more top down tools. So these are, looking at the broad asset classes first from the top, and then looking down into risk and return features there. We use different tools to do that work. Techniques like portfolio optimization or scenario analysis. These are different things that help inform how assets fit together on a portfolio level, and hopefully, provide a blend of those assets that gives you sort of the most bang for your buck in terms of return per level of risk taken. And so we incorporate sort of a wide range of capital market assumptions. These are basically large institutions like JP Morgan, Wells Fargo, et cetera. They have a lot of very smart individuals there, and they seek to project levels of return and risk for various asset classes. We use those inputs to inform our models, and again try to seek that blend of assets that equates the strongest return per level of risk across the growth client, the moderate client, and the conservative client. And so with that context, we thought it'd be pretty interesting when we pair that with what we call meta themes or mega trends. These would be things, if we looked like in the early 2000s, kind of like the rise of the internet. These are important for our entire world, and they're going to change how investing works and which stocks do well and which stocks do poorly. So with that context, we thought it'd be interesting to look backwards for perspective. And so, Scott, you've been doing this type of analysis for a couple of years now. Why don't you walk us through the Pinkerton portfolio piece that you were able to dig up going all the way back to 1990?
Yeah, it's fun. One quick comment about the bottom up and the top down. So what you'll find when you work with a planner is the first thing we want to do from the bottom up is to make sure you have the cash flow that you need through the dividends and interest payments that you have coming in, plus bonds maturing. That way we know that where your money's going to be coming from and that it's secure. Then we look at the top down and say, okay, maybe that's 30% of your portfolio, maybe it's 10%. We might want to round it up to get your allocation. But yeah, the other day, one of the great blessings of being in this business is you get really close with your clients. And I had such a client, and their daughter came in, and they were cleaning out some files after the client had passed, and they had found about 15 of these Pinkerton portfolios, which was a newsletter that my dad and I put out in the 1990. So he passed in 91. So didn't put him out for that long. But we've had a history. And one of the reasons why FourThought has been so successful is we've identified, and it's not heroic. We're not really, when you hear our meta themes, you're not going to say, wow, that's mind blowing. You guys are so insightful. I never thought about it. No, it's things that are really kind of obvious. But once you name them and then you start navigating the investments around those themes, and you have processes to test to make sure that those themes are true, it can really make a phenomenal difference in your portfolio. So, back in 1990, I was looking at this one that they handed in. One that my client gave me was from summer of 1990, and evidently the Japanese markets had just gone down 25%. And it was ironic that they were so overvalued. And I was talking about how overvalued Japanese real estate and stocks were at the time. But that was a time where everybody was thinking about Japan Inc. Just this month, the Nikkei stock exchange has gotten back to the level that it was in 1990. So when people say, stocks always make money more so than bonds in the long run, that's been a good 30-year run, or more than that, almost 40-year run for Japan, where they didn't get back to where they were. So it's fascinating. What I'd like to say about when you're doing these mega trends is it's really important never to be dogmatic. We've read a book by Tetlock named Super Forecasters, and the name doesn't really do it justice. But the idea is that you have a way as a team to identify themes and then test them constantly to make sure those themes are correct. So we're going to be going through a couple of those themes right now. But before we do, let's get right to the chase and share with you where we're going to land. And that is our 2026 asset allocation changes. Jake?
Yeah, just quickly running through these. Certainly had a couple changes going from last year to this year. We increased our allocation to international stocks and also inflation protecting securities. We'll talk about the why throughout the webinar today. Don't fret on that. We've also maintained a robust position within technology companies. Again, we'll talk about the valuation of those stocks broadly and what some of the earnings trends are too, and why we still have this position. With fixed incomes, we do prefer to keep allocations short and small, we say. And what we mean by that is individual high quality bonds that mature over a 5-year period, not really a whole lot longer. And overall, keeping the bond portion to a minimum. Our concern there, and we'll talk about this more, is within inflation and how inflation can kind of erode that purchasing power of bonds over time. And then lastly, we're keeping our exposure to alternative investments. These are securities that just don't function a whole lot like stocks and bonds. This could be assets like private equity, real estate, even infrastructure securities, MLPs. We're looking for diversification benefits here, as well as inflation protection and cash flow generation. And so, Scott, if you have anything to add to sort of the asset allocation changes, please do. But if not, I really want you to get into sort of the stars and what we're looking at as sort of the next long-term themes.
Yeah, this slide says a lot. And when you look back at what we've done in the past, we've had, relative to normal investors, a lower allocation in bonds because of our concern about inflation. And that we're sticking with. We've had a higher allocation to technology, although the market's caught up with us. So what are some of the new themes and some of the old themes that we are resurrecting, so to speak. One theme that has been enormous, there was a book written by Harry Dent maybe 15, 20 years ago called, that wasn't the population bomb, but it was basically about the baby boomers aging and how they were going to be hitting certain levels and what that was going to mean for the markets. And they pointed out that in the 60s, you had bowling alleys and you had yuppie cars, and now you can see the number of retirement centers that are being built, et cetera. But that's an enormous impact because we have this huge bubble of people that have moved out of the workforce and into retirement. So the number of potential employees in the United States is dropping. Another impact is what we had called the Walmart effect. Over the last 30 years, globalization has been a big wind at our back. Sam Walton started squeezing supply chains and doing things direct and outsourcing things all over the world for the benefit of consumers by lowering prices. That took inflation down substantially. There's two types of inflation that we'll talk about. One is cost push. That's where the cost of products go up. And the other one is demand pull when there's a lack of supply. Cost push inflation was basically eliminated through the globalization Walmart effect. The other theme that we had in the last 20 years was the emerging markets march to modernity. So try to say that 5 times fast. But you had countries like Brazil and China and Singapore, et cetera, that were rapidly growing their GDP and were joining into modernity. And you saw a lot of those markets substantially outperform, maybe not in the last 5 to 10 years, 8 years, but over the last 20, that's certainly been the case. And the last thing that we've invested in over the last couple decades is the technology revolution. The players have changed, but the revolution continues. So there are still some of those that are in place. The technology revolution, it's picking up steam. The demographics have changed. There's a new one that I call economic nationalism, or call it Cold War II, that we'll talk about in just a second. And a lot of the items that we're looking at as trends, they really have counterbalances to them. So we'll talk about, for example, the effect of the workforce shrinking through low birth rates, high retirement rates, and a lack of immigration. At the same time, we have huge productivity enhancements where we're increasing our output without increasing our cost, the number of jobs, which, it's a balance that is a tension that we have to manage. And then you have this deglobalization that I'm going to be talking about, which is onshoring of a lot of the things that we were offshoring. That's happening, which should create inflation, but at the same time, because you have higher prices, at the same time, you've got deregulation taking place. So we're going to be talking about that paying attention to the tension. Jake, anything you want to add?
No, well said, Scott. Yeah, let's continue on.
Okay, so the first thing in the 90s that we were picking up, not quite just so here, but after the Berlin Wall fell and the Cold War was over, there was something called the peace dividend. And you heard people talking about how the world was going to be a big benefactor as nations spent less on unproductive things like a bomb that you spend money to make, and then it blows up and destroys stuff, which destroys productivity and destroys the capacity to make goods and services. So that type of spending, there's some people that believe that you could pay somebody to dig a hole and then pay somebody to fill it up, and that somehow that's increasing your productivity. It's not. You're just increasing the money supply because you're paying people to do things that don't add any goods or services. And when you do that, you create inflation. So defense spending, we had a huge expense, and the idea was in the 90s that we were going to be able to taper that off and that was going to go away. Well, obviously, That idea is not even talked about in polite circles anymore. We see country after country saying, we have to be spending more of our GDP on our defense, and it's primarily you're seeing this in Europe, but also Japan, and obviously in Asia, where Germany and France, not so much France yet, but Germany especially, is going from spending about 2% of their GDP to over 5% of their GDP on security issues. Also, countries like the United States and Germany, et cetera, are revisiting supply chains. The idea was that, hey, if we can get our drugs manufactured in China cheaper and then ship them over here, it's a win-win. And then when we found out during COVID that we didn't have the supply of products that we needed, we realized that certain supply chains are really a matter of national security. So those were some big changes in our thinking. And when you realize that that's probably not a trend that's going to go away, regardless of the party in power, what is that going to mean? And you add in tariffs to that, and you're going to see the cost of production, kind of globally go up. I'm not saying it's good or it's bad. I'm saying from an investment perspective, it is. And so what do we do as investors to prepare for that? How do we position your portfolios for the good, the bad, and the ugly that comes with the deglobalization? Okay. Another thing that's changing is I call it Chimerica. When China entered the World Trade Organization in the mid-aughts, what was happening, and it happened for a good, more than a decade, is we would buy cheap goods, and primarily goods, from China. We would ship them our dollars. They would invest some of those dollars, but more often than not, they would go and buy our bonds with the dollars that we shipped them. What did that do for us? Well, we had someone that was an earnest and eager buyer of our debt, which means that we could continue financing our goods, our government deficits at a low rate. And so it was this nice little circle of scratching each other's back. They were getting, bond assets that weren't really that productive. We were getting cheap products and investing in areas where we were more productive. Well, the Chimerica trade is done. You could see the graph, here you see a recent Wall Street Journal article, how American and Chinese economies are hurtling towards a divorce. We have technology that they need. They have rare earths that we need. We have soybeans. They have cheap goods. There's a lot of things to unwind, and it is such a large amount of trade that it's not going to go away tomorrow. But I think we can all see the writing on the wall that the Chimerica relationship is quickly devolving. And just this week, for example, I heard that the Chinese premier was talking to the Chinese bank, saying, "Be very watchful of how much you put into U.S. Treasuries." So this is not going away. Jake, any comments you want to add?
I think as we get to the next slide, Scott, and it really resonates with the article that we had there about Germany sort of increasing its infrastructure as well as defense spending. As you mentioned, if you just increase spending on something that really doesn't provide a lot of value, we're talking about maybe like a missile or something like that you spend a lot of money on and then it just blows up at the end of the day.
Right.
It's just production, but it is also inflationary as well. And so as we look at sort of developed monetary policy here, we can kind of see where we've come, and then on the left-hand side there, and then you can kind of see the dotted line is the expectations. And so we are in an expectation where we'll probably be lowering rates, probably very slowly, but still the expectation is maybe a few rate cuts this year. Whereas the Eurozone central bank is expected to begin raising rates. The same with the Bank of Japan. And so that could be, their idea of, hey, we're starting to see inflation creep in and from the stimulus package that we've put out. So we got to kind of curb that. Scott, what does this, slide sort of speak to you there? And then why don't you talk about the government fixed investment as well?
Yeah. So when you look at investment returns, one item that can impact returns both on your bonds and your stocks is the value of the dollar, and almost as importantly, the direction of the dollar. So understand that US dollar is the global currency, and that isn't likely to change anytime soon, although it's not quite as dominant as it once was. And when the Fed lowers interest rates, you basically are increasing the amount of dollars that are in circulation. It's making it easier for people to borrow. And when somebody borrows, that's basically the same as printing money, right? So a lower interest rate increases money supply. And like anything else, there is a supply and demand component. If we are importing a lot and we're shipping a lot of dollars out, that gets, that offsets that supply and demand a bit. So what we see happening is the dollar weakening, which will make our products more attractive to export, but it'll also make products that we import more expensive. So that might be a great policy, but what it's going to do is it's going to create more of that cost push inflation that we see. So looking at what's going on with global interest rates is important because you can see that other countries are going to be raising their rates. We're going to be reducing our rates. So we think that that's an indication of a continued, it's one of the reasons why we think continued dollar weakness is kind of in the cards, not to mention it's kind of the stated policy. On the right, you see spending. So you have on the far left what's happened from 2000 to 2007. You can see UK did a lot of government spending, but really from 2010 through 2019, all of the governments, including ours, did very little fixed investment spending, building projects, that type of thing. You can see from 22 to 27 that is ramping up dramatically. So again, it's getting back to this economic nationalism that we see. Countries are starting to think seriously about how do we stimulate demand within our economy? How do we get more Germans to buy German products because we're not able to sell German products as much internationally? That reduces globalization, but it also increases cost because you're not going to the most efficient producer oftentimes. Again, I'm not saying it's good or bad, but I'm just saying we need to be prepared for that cost push inflation when it comes from the global trade. Another thing that we talk a lot about, and I mentioned earlier, are these polarities. A polarity is when, like, inhale and exhale. They're two opposite things that you need to survive. So inhale and exhale is an example. These are not really polarities because they're not mutually dependent, but they're just teeter-totters. They're things that are balancing issues that might seem to be really problematic. Coincidentally, now there's another thing on the other side of the teeter-totter to offset it. So we have, again, lower birth rates, lower global migration, a huge part of our population that's turning elderly. So what Harry Dent and everybody was expecting is that we would have labor costs going through the roof, and it would be just a mess because we wouldn't have enough people to serve those that were retired. And the reality is that productivity has just been incredible. We're able to do more with less hourly labor, and that's just starting to accelerate. So that's kind of an offset. And as I mentioned earlier, the deglobalization, the deregulation. As we deregulate and make things easier to get approved and built as far as infrastructure and other things, that's creating a balance to that cost push that we see. Anything you'd want to add to that, Jake?
Yeah, I think, really well said. Agree with everything there. The only thing is, we know that these forces will have some sort of counterbalance, but they're probably not going to be fully equal, right? There'll probably be one side that does a little bit more. And so we are expected to see maybe some shifts there when we look at inflation and we look at, labor force participation or productivity, unemployment rate, right? We do expect to see some change there, but we're not exactly sure which force is going to outweigh the other.
Right. You have to, and one of the things I want to prepare people for is they're not offsetting each other with perfect timing. So we need to be prepared for real jolts. It could be through political reactions. It could be through labor force strikes. It could be, there's all sorts of things where this tension will reveal itself because it's not going to be a smooth transition. I think about other major industrial changes like the Industrial Revolution. Imagine when the cotton gin came out and 90% of the workforce was on farms, and suddenly, especially in the South, you didn't need that. Obviously, there's a lot of other things going on during that period of time, but it was a huge disruptive technology, and you had a mass migration from rural to urban, and you had huge impoverishment. You had this really big change between the haves and the have-nots. You had the robber barons with these new industries like steel, railroads, and then later on telephones, electricity, et cetera. So it wasn't exactly timed, but if you take a step back, you can see that they kind of counterbalanced each other. We see that happening now, but it's not going to be a smooth ride. So as we look at those meta themes or mega trends, as you will, we also have these swells, the things that we see going on short term that we need to pay attention to, because you can be navigating your boat towards your long-term star and get kicked over by a big swell. So we want to be careful of that. And some of these include technology and market concentration. Jake, why don't you walk us through some of the others?
I think the main thing here that we're seeing is like a lot of cross currents. And again, we talked about like polarity, but I mean, these are major either economic or market indicators that are sometimes pulling in different directions. So certainly as we look at the stock market, we can't ignore tech valuations and how concentrated the market's gotten. We'll talk about that in just a couple slides. We got some other changes that are upcoming too, such as a new Fed that's going to be stepping in. Also, there's been this built up expectation that we are going to be in a period of high growth for, at least certainly for domestic stocks when we look at profits. We'll talk about that. And, is the market really overvalued through that lens? International and small caps, these are areas where you can't ignore. And we saw that effect last year through international. That's why we talk about having a well-balanced, diversified portfolio, because even though the US stock market has dominated international stocks over the last 20 years, last year we saw that script was flipped. And we think there might be some more of that into the future as well. And then also as we look at potentially higher inflation and what that might lead to, really taking a look at the alternative allocation that you have in your portfolio, specifically pertaining to infrastructure, power demand, things like that you don't necessarily reside or are common names within the S&P 500 index, but are going to be crucial for us. So Scott, why don't we get into it and we can talk about, first off being this market that we're in right now from domestic, looking at the S&P 500, we saw the last kind of blip was back in 2022, where the market corrected by about 25%. And you can see the quick rebound that we've had, whereby we've almost doubled the S&P has since that period there. What's important to know is that we've had strong earnings growth over that time frame, but it has not been enough to slow down this valuation or multiple expansion that we saw. And so the price to earnings ratio being, one of the most frequently cited valuation characteristics there, increased from 15.7% at kind of the trough to now being around 22 times earnings. And if we look at this, kind of the next slide, I think is really important to level set and show us at 22 times earnings, we are certainly a lot more expensive than the average price to earnings ratio. In fact, we're at sort of a high point that we've only seen kind of directly coming out of COVID, where a ton of stimulus poured into the economy. There's speculation, and there's also growth as well. But then before that, you have to go all the way back to sort of the turn of the century, looking at 2000s, where it was just ripe for speculation and, bidding up companies that even had no profits. So Scott, I want to pause there. I want to give you a time to reflect on this before we get into maybe the why of why the market's expensive and sort of how the index can really be broken down.
Yeah, I think if you're listening, you're thinking to yourself, oh, these guys are pretty negative about the stock market because things are overvalued. Wrong. We'll explain why in just a second, but recognize that we are pattern recognizing storytelling machines, we humans. And so we see patterns when there aren't any, and we'll assign a story and give it meaning when the story could be completely disconnected. So just keep that in mind as we look at these graphs and charts, because investors are constantly falling victim to that. But to give you an example of what I was saying with earnings, is yeah, these earnings are the multiple that the stock market's trading at is very high. But Jake, how does that relate to the actual earnings themselves, and
Yeah,
why?
even if I think we take a step back, right? Because I think this is important, and you hit on this, Scott, but just because we have high valuations, that doesn't cause markets to just fall. However, it can reduce what investors can reasonably expect to earn in the future. So one thing that sort of is very commonplace in CFA, in fact, it's CFA level one material is looking at sources of expected return. You can get return from equities from the dividend yield that it pays you. You can get expected return from the earnings growth that the stock has, and you can get expected return from the change in the PE multiple. So because of PE multiple, we've had sort of a tailwind that helped us out and boosted returns. That doesn't mean it's going to just turn returns negative and we're going to go into some correction, especially because a crucial component is that earnings growth. So if we look at this here, we can see that the last year, or I'm sorry, in 2024, we had 10% earnings growth. Last year, we had 11% earnings growth for the S&P 500. The next 2 years, analysts are expecting 15% growth in earnings. To put that into perspective, if we look at the last 25 years, which is one of the greatest bull markets that the S&P 500's ever had, the average earnings growth was less than half of that. It was around 7.2%. So truly, the next few years, these stocks are churning out high degree of profits. Their revenue is growing, but even more importantly, on the right-hand side, we see their profit margins, which have expanded to almost 14% now for the S&P 500. And you can look over the last 25 years through great returns of the S&P 500, and 14% is well above almost any other time period there. So that's really important. You can't just say, hey, the valuation's high. In fact, one item that we look at, it's called the PEG ratio, and it stands for price to earnings ratio adjusted for growth. So you take the PE ratio 22 times. If we're expected to grow at 15%, you do 22 divided by 15. We're a little bit north of 1%, which is typically true. And if you look historically at the PEG ratio for the S&P 500, it shows that we are much closer to the average PEG ratio. It looks a lot different than if you only look at the PE ratio by itself.
Yeah, I think that's the critical element. So when you look at this chart, you'll see that the dark part of each bar is the margin component. And remember that the technology component of the S&P 500 has gone from 20 to 40%. As these companies grow, the stock plus the number of shares outstanding, their market capitalization grows, they get a larger and larger representation in the S&P 500. So as their representation grows, these are also companies that have enormous margins. You got companies like Google that have very small workforce, very big revenue. So they have 50, 60, 70, 80% margins. So as those companies representation gets higher in the S&P 500, the margins of the S&P 500 get better. So our economy, as measured by the S&P 500, is getting more and more like a tech index and less like a diversified index, which is why you're seeing these PEG ratios. Yes, even though our PE multiples are high, these companies are still growing. Nvidia is still growing at 30%. It's incredible how quickly these companies are still growing. So yes, from a nominal basis, the PE multiples are high, the price to sales are high, but from a margin adjusted basis, not so bad. So there's no reason to be panicked about current valuations. I love this chart here, Jake, because it talks about the stock market composition, the 10 largest companies of the S&P 500 by decade. So if you go back to 1985, can you see my cursor there?
Yes.
IBM was the largest, most valuable company. Now this shows that it was, like 8% of the index at the time. IBM in 1985 had 400,000 employees. So you could see how much labor and how labor was important. That was a technology company. You look at today, and you can see the total market capitalization of the top 10 companies is more than double than it was in 1985. But if you look at NVIDIA, just as an example, which you can see my hovering there, it's the largest, as of this morning, company market capitalization. NVIDIA has 20 times more valuable than IBM. If you look at the market cap, it's 20 times more valuable. Where IBM had 400,000 employees, NVIDIA has less than 30,000. I mean, that just is mind-boggling that the largest company in America by market capitalization has only 30,000 employees. And it just shows you that company is cranking out the profits. It's got a chip that is really irreplaceable, and there's no end in sight as far as their needs. Maybe there's some Chinese chips that are coming, but really we'll get to that in a second. There's not. So, that stock's trading at what multiple now, Jake? NVIDIA, high 20s?
Yeah, high 20s. Mm-hmm.
Yeah, so it's that's incredible. Since 2019, S&P 500 profits are up more than 40%, and yet wages and benefits, if you add them together, are only up 10. So what we're seeing is an economy that is getting more behind capital investments. And, we might say that's horrible, the American worker. And you see this tension in the polling now where it seems like our economy is doing great and the markets are doing great, but the average person out there is saying, yeah, and it doesn't feel so great. And you can see why, because you can see the value of these companies going up, and yet wages, they're not keeping up with profits, obviously, anywhere close. But the reality is that we don't have the workers. If we had the old productivity that we had in 85, we would need 3 to 4 times the workers that we have today. So
yeah,
there's been an enormous investment in capital, and we'll talk about that in just a moment with what's going on with this hyperscale build out. It's just mind-boggling what's being invested. And that's going to be the answer to our lowering demographics, probably. So that's a trend that we think is here to stay. I'm not saying where it's good or bad. I'm just saying it is, and we need to align investments appropriately. One of the big things that we're looking at is a more stubborn inflation. I am thrilled with Kevin Walsh, the new Fed chair. He is a monotheist. No, that's theological. He is a monetary. He believes in monetary economics. So money supply, like Milton Friedman. A monotheist is one person that believes in one God, obviously. But anyway, he is definitely focused on slowing down quantitative easing and looking at money supply as the key controller for Fed actions, and not getting all these other mandates confusing on us. But when you look at inflation, the chart looks pretty good. Let me get my cursor going here. But Jake, what's behind the numbers here? So tell us what you're looking at, and then what the most recent numbers share.
Yeah, first and foremost, right? We take a look going all the way back to 2018, and each bar is one of the quarterly CPI adjustments there, right? The year-over-year change. We saw that spike all the way back in June of 2022 to above 9%. And then we've seen this steadily come back down. The most recent print, we had, quarter that due to the shutdown, we didn't get that data there. But the last print was right around 2.7%. And bigger picture, it's kind of been stubborn around this 2.5% range for the last couple quarters now, really over the last almost year. And the idea there is we've got a 2% target inflation number. We're not there yet. And, will we get there? I think is the big question, especially in spite of maybe more dovish monetary policy, meaning, hey, they might continue to bring rates down and sort of stimulate the economy a little bit. The big thing though is looking at the different color, which represents the different components or contributors to CPI. Energy is light green, and as you can see over the last year, that green bar has been under the x-axis. So it shows that we've had that's been going in our favor. Some like disinflationary stuff happening within energy. That's not going to last forever. So that's been kind of a tailwind in bringing down overall CPI. The other big contributor historically has been shelter costs. And we talked ad nauseum about how that's a lagged indicator and we expected it to slowly come down. And it absolutely did. Now, the question would be, how much lower can that really go? And where is the inflation ease going to happen to get us from over 2.5% down to 2%? I think that's the big question that everybody's asking.
Yeah, so housing costs, and we've talked about this in the past. You got multifamily housing projects where the rents are coming down, but you have a housing market that's been somewhat frozen and housing prices haven't come down, although we're starting to see pockets of it. So we expect to see inflation go lower on the short term because housing costs will continue to come down. On the other hand, energy costs are going up and away. And we'll talk about this a little bit later, but the demand that's put on our grid now because of the consumption of these large language models, i.e. AI, is enormous. And that's kind of a sneaky thing that's happening and people aren't seeing it, but the electric bills are starting to really, really have an impact. Let's get back to the dollar, Jake. We've made the case about international investing and how the dollar impacts that, but what's been the long-term kind of trend of the dollar? And then how does that correlate or not to the outperformance or underperformance versus domestic stocks?
Yeah, absolutely. This is a great chart if you're a nerd like me and want to take a look at it here. Let me explain this and break it down a little bit. So we've got the x-axis. This looks at the international stock market versus the U.S. stock market. So the x-axis shows that they are both provided the same amount of return. There's no difference in international versus U.S. stock performance. If you go above the x-axis, that's showing where international has outperformed the U.S. markets. And if you go below the x-axis, that is where the U.S. has outperformed international. Now, what you can see right off the bat is for the last, almost 20 years, we've been in a cycle of U.S. outperformance by a pretty large amount. What you'll also notice is interesting is there's some shading happening throughout the chart that goes all the way back to 1975. The shading there is periods where the US dollar is in a declining stage, where it's weakening. And you can see that in every single instance there where we've had shading, you get a cycle where international stocks outperform US stocks. It is a tailwind for US stocks when the dollar is in decline because your investment performance internationally is compounded by when you translate those dollars back to US dollars from the foreign currency. And so I just think that's a really interesting slide. We've started to get into a period where the dollar is in a decline, and you can kind of see here what happened. And to break this chart down, I'll first start on the very right-hand side, which looks at 2025, last year's equity returns. And you can see the top bar there was the Eurozone, which increased by over 40%. You can see EM was right behind it. China,
EM
Japan.
is emerging markets, right? Yeah.
Yep, correct. Emerging markets. China, Japan, all did better than the US stock market. Now, what's important too is if you look at these bars, you get different colors as well. I'll point you to the purple, which is very, very large within Euro and the
Oops,
emerging
sorry.
markets. And that purple is looking at just the currency translation. Has nothing to do with if the companies had strong earnings, if they paid high quality dividends. Those are the light blue and the dark blue. It doesn't also matter about the valuation of the market. We've talked a lot about how international stocks were cheaper than US stocks. Well, we started to see a little bit of multiple expansion. So all of that was even pretty benign relative to the currency expansion that we saw there. Now, what I want to do is compare that all the way to the left-hand side, which looks at the last 15 years annual return figures. You can see within this cycle, US stocks have handedly outperformed. In fact, they doubled
Sorry,
and in
Jake.
some that's okay. And in sometimes tripled the returns of the other asset classes. And what I'll point to there is what's that purple bar doing? Well, the purple bar for Japan, emerging markets, even Eurozone, going in the wrong direction, right? There's been a headwind in terms of currency because we've had a strong dollar. Now, if we go into a period of time where we have a sustained weak U.S. dollar, which is, what it looks like, that trend might continue, that would still paint a very strong picture for U.S. stock for international stocks in terms of their performance versus the U.S. stock market. And again, this is another chart that shows us the drivers of the U.S. dollar. I think, pretty importantly, if we start on the left-hand side, you kind of see a cycle from going from 2008, where we had the last, great financial crisis, all the way back to basically when we had that really high inflation numbers back in 2022, where the U.S. dollar appreciated by over 50% in that time period. Just over the last year, the US dollar has declined by almost double digits. And one thing that's very, very important is it's called interest rate differentials. And so that would be on the right-hand side, the bottom right chart there. And what this looks at is the difference between the US yields, the 2-year yields, versus international yields. And we've seen this trend down. Essentially, what's happened is the US has started to reduce their interest rates, which does have an effect on the 2-year, which has come down. Similarly, international central banks have either began increasing rates or have just not decreased rates at the same pace as us. And that's led to this differential declining. And essentially, what that means is very, very simply is investors at the end of the day, they want to go where their capital is valued. So investors that were buying U.S. bonds because they were at a higher rate before, but now they can get a higher rate maybe in the Bank of England or within the Eurozone. Their capital might flow out of US bonds and into European bonds. And the effect there will have a lowering effect on dollars because there's less demand for US dollar denominated bonds and more for maybe European bonds, et cetera. And so that right there can paint a pretty negative picture for the US dollar looking forward.
So I want to remind everybody to go back and you know how to ask questions. You want to walk them through that one more time, Jake? There's a button that they hit.
Yeah, absolutely. If you look at the bottom of your screen, there's a Q&A box. You hit that box, plug in your questions, and we'll start to get those as well.
Okay, so let's wrap things up with our discussion of tsunamis and black swans. Some of these things I'm going to skip over and share with you some slides in just a moment. But what if big tech, and these are just things that we're thinking of, and frankly, I've read others think about them as well. What if this huge investment that the big technology companies are making, what if it doesn't pan out? What if they can't figure out how to make money off of it? What if they can't monetize it? What happens? Another thing that we're seeing is data centers that are being built and they can't get power or they don't have enough water. What happens if we don't have the ability to power or provide water to support the AI boom. Another thing that's concerning people is, you had this deep seek by China, where they were able to run something that was the equivalent of ChatGPT 2 with less energy and with the same speeds. Is there a chance that America will lose its technology edge? And what will that do to our stock markets in the long run? And then, one thing that we're all obviously got our eyes on is what happens if China invades Taiwan. And there's all sorts of other things that we could talk about, like perhaps we have something going on in Iran within the next couple of weeks. What are those things going to do? But let's just start with tackling this Capex spending. It's really hard to put into a graph how radical it is. So here you see the previous big capital projects, and these are all adjusted for inflation, by the way. And it's as a percentage of our peak GDP. The Manhattan Project, the electrical grid build out, the Apollo highways, broadband in 2000, which was enormous. The Capex spend today is more than, it's about the same as all the other ones combined. Google today said it's going to be investing or issuing $20 billion in bonds. They're doing a 100-year bond priced in sterling. So they're issuing them in Swiss francs. So these tech companies that heretofore had very little capital investment, therefore they had these big margins, which supported the high multiples, suddenly they're spending like crazy. And will they get the returns that we expect them to get? And by the way, you can see that Google's, by issuing the debt, they're hedging their bets on the US dollar. Now keep in mind that Google had $328 billion in revenue last year. So it's not like the amount of debt is overwhelming. So you can be the judge of that. Is AI here to stay? Are robots coming? I think the answer is clearly yes. You're not going to be, I was talking to a friend the other day, you're not going to be what they call a Luddite, which was in England when they developed the weaving presses that were so efficient. And a group of people they called them Luddites, when they destroyed all the presses, all the new weaving technology, because they didn't want technology to roll on. Well, technology is rolling on. So I think I think that this is a concern, but it's not one that, as we look at the data, that we're overly concerned about. But it's something we need to watch, obviously. Jake, any comments on that?
I think it goes hand in hand with the next slide, Scott, if you want to navigate over there, which is the immense power demand, right? Like, where is the Capex going for those companies? Well, they're going towards buying chips, building out data centers to train these AI models, and the immense power demand needed for training these models, as well as just using the models, is growing and growing. So on the left-hand side, this takes a look going back over the last almost 10 years now. Basically, the very first AI model that came out, and then each one of those blue dots represents sort of the next AI models that have come out. You saw ChatGPT there in 2020, GPT-4 coming out in 2023, Grok's on there, etc. But the idea there is the power used to train the models is growing and growing as the models have become more complex. And the rate of change is about over 2 times per year, that growth. So, if you expand that out over the next, 2 years, 3 years, 5 years, 10 years, you can tell that we're going to have immense stress on our grid. And I think that kind of goes hand in hand to the right-hand chart there, which looks at construction spending. The red line is within electric power. I mean, really didn't see any increase in that until 2020 happened. And then you really saw that pick up. Conversely, you see the trends with office buildings and data centers. Those charts are almost flipped, whereby, office building had sort of been steadily rising until COVID and then started to decline, whereas data centers virtually dormant until COVID and have now started to grow into almost like a parabolic or exponential growth pattern there. Scott, anything you want to add on there? And one thing too is, as we look at China as being a threat, they have certainly invested a lot more in the infrastructure and in power, to really build that out in advance. I think a little bit better than we have.
Yeah, let's just comment on that. Our approach is that we have electric utilities, and I guess sometimes we're having, for the first time I don't want to say first time in American history, but it's unusual that we have these government interventions where they're taking a position in intel and kind of an industrial policy. And we all look at what China's doing, like with, oh boy, if we could just do that. But remember, China built enormous cities that are still vacant. And so when you have, kind of top down folks making decisions based on prognostication and they're not putting their money where their mouth is, they might be, but they're not, it's not their money. I think we're investing an enormous amount, but it's just not from our U.S. government. I mean, what the AI hyperscalers are doing is enormous. While you were talking, I was trying to think about this Billie Holiday song. It was called "Strange Fruit," and it was from the 30s, and it was about these terrible lynchings and stuff that took place. And one of the things I love about Billie Holiday is when she was a very popular jazz singer, but she also spoke the truths of what's going on. And we can get caught up sometimes in the scary part of AI and some of the things that it's going to do to the things that we see. But what we see is not all that there is. And we fail to think about what it's going to do with drug discovery. I don't mean illegal drugs. I mean finding new drugs to help, with patients. And there's so many applications that can happen. Another thing that Billie Holiday said one time when I was reading the Rolling Stone back in the day, that by the way was a magazine that came out. Jake, you may not remember it.
What's a magazine?
Anyway, they were interviewing her, and she said, "Hey, you were right in the middle of this. You were blues, jazz, rock and roll, kind of all this and wrapped up into one. What was it like to be part of the revolution?" And she said, "Hey, if I would have known it was a revolution, I would have paid more attention." I can tell you that we are in the middle of a revolution, and it will change forever the way our world functions. And it's like a revolution that I've never seen before, or that I've ever read about in history. I mean, the only thing I can liken it to was electric utilities and how that changed, the world as they knew it. Now, when you look back at those times, there were winners and losers, but there were also a lot of fads. And you had companies like RCA that came out of nowhere and just were worth, just worth an enormous amount. But Thomas Edison himself, who ended up being very wealthy, blew it on a lot of schemes. So we have to be cautious. We can't get overly optimistic. We have to have balance. We have to survive to fight another day. But we also need to be paying attention. So this build out of the electric utility stuff. Elon Musk talked last week about putting solar panels in space and then somehow getting them down through his satellites for power. And he says, hey, the sun never stops shining, and they don't have the cooling requirements. And there's so many other, and the sun is so much more powerful that the energy it can generate, is enormous in comparison. So is that going to be the solution? I don't know. I'm glad that he's putting his money towards it, because if it works, it's going to be great. You can assure you that Amazon with their satellites is not far behind. So there's a lot of stuff going on, and you need to be invested. One thing I want to talk about alternatives. You need to be invested in some of these alternatives to have a position there. Now, alternatives, people get freaked out because it can mean so many different things to so many people. Real estate, you can purchase a stock on the stock exchange called a REIT that gives you exposure to real estate. And real estate's an excellent inflation hedge because they have contracts that increase their rent. Yes, there's some dislocation as people move from offices to retail, but they're still going to restaurants. There's still, an opportunity in retail, that type of thing. You have other things like MLPs, which are publicly traded. You can buy them and sell them like a stock on the stock exchange, but they own pipelines that carry natural gas and oil around the country. You have electric utilities, which are a classic alternative investment because they're investing in the infrastructure. And I think this is a really wise place to invest because these electric utilities are being called upon to build nuclear, to build solar, to build wind, and to build our capacity so that we can support AI. You've got small companies that are doing power cells and small nuke power. It just so many things are happening in that space. I call it an alternative investment because it's not like a direct investment in a diversified portfolio of stocks, but they're electric utilities and they're publicly traded and they're a pretty typically conservative investment for folks. So when we look at what we're recommending folks do to kind of wrap things up, overweight U.S. equities, we still think that heavy technology is going to be the place to be. Overweight international, relative to what most folks are saying, we think that's going to be powerful. Underweight bonds, I'd like to have as little in bonds as I can and still cover my 7 years worth of spending. And then we equal weight alternatives, but make sure that the alternatives are designed for you. So if you're a younger person, you may want to be in an alternative investment that gives you exposure into the private markets that are investing in some of these new technologies. Wonderful. You can get outsized returns potentially when you select the right managers. If you're an older investor and you need to get income, focus on those electric utilities. They're going to be keeping up with inflation and probably growing faster than inflation because of the demand for electric utilities is exploding. So there's a portfolio for everybody depending on growth, liquidity needs, age, income needs, cash flow needs. With that, Jake, any last comments before I wrap up?
No, I think the last one would just be don't forget basic investing principles, right? We all know about the time in the market beats timing the market. And some of these things that we might have mentioned, they might resonate and they might strike a chord that might be fear inducing and things like that. We just really encourage you get a call over to your planner here at FourThought, get back into what your financial plan is and if you're on track or not, and use that to base your decision, not something that's just based out of fear, because we've seen that play out, and a lot of times it just takes your portfolio to a place that isn't bringing you closer to your financial goals and your financial objectives. So with that, Scott, let's take it home and let's get into our Q&A session.
Yeah, so I would just wrap up by saying the good old days weren't all that good and tomorrow isn't as bad as it seems. That's an old Billy Joel song quote. And I've been through a lot of turmoil. Right now, everybody's feeling wealthy. There will be a scare. I promise you it's going to happen where something occurs that nobody's expecting and markets drop. I think you go back to the long term of getting assets that are going to grow faster than the rate of inflation. I don't like investments that don't generate cash flow and earnings, a la Bitcoin and things like that. So you don't see that in your portfolios because when the going gets tough, we want to actually have earnings or dividends or interest payments that we can collect and reinvest. So with that, good to talk to you, and let's open it up for questions and answers. So howdy doody, Jake.
Hey Scott, we got some great questions here, and first off, Scott, we went a little long there, right? So first off, wanted to thank everybody who tuned in for staying with us, and we really appreciate your support. Hopefully, you've taken a little bit of nuggets from this conversation, and got a couple questions here, Scott. So I'll throw the first one over to you. Maybe you can answer, and then I'll sort of opine on it as well. But just about any kind of major fluctuations within tech stocks, right? We talked about how they're getting a little bit expensive, especially with AI companies and some of the chip manufacturers. Can you walk us through, if there's sort of a blip there or a fluctuation, what kind of effect that might have on the overall market and especially index funds?
Yeah, when I first became aware of it, one of the first things I thought of is this is going to be terrible for Google. Because why would anybody search for something when they can get an answer, without having all the ads? And Google stock didn't do so hot for a while. And Google last year was up 60% plus. And so what seems like an obvious impact isn't always so obvious. I also have a cautionary tale. I remember a friend of mine, banker, had his 401k. He switched banks as they often do, and he took his entire 401k and put it into AOL. And at the time, nobody could imagine an internet service provider that wasn't dial up. And now we laugh at that. Of course, there's going to be dial up, but you cannot see the future and you don't know what those winners are going to be. So, you have these like the last 3 days. I think last week it was software companies that nobody's going to need to pay Salesforce, $2,000 a month to keep their client data when they can put it all on AI. And, here at FourThought, Jake, we're experimenting with using AI in different ways in a protected environment. And, what is that going to do to the different software providers? Well, then the next day, it was insurance underwriters. They
Yeah.
got taken to the woodshed. And then this week, it's financial services companies. They're saying, hey, why would somebody want to invest their money at a fee of this when you can have AI, do all your tax preps and all of your consulting and stuff. And I can tell you that AI is really helpful. There's just a lot of data that we need to remember and know. And so it's very helpful, but there's also, it's not perfect and it creates some problems. So, there's a lot of volatility as a result of AI as we're trying to figure out the winners and losers, and that's going to continue. And I think about, having an allocation with those large companies that are going to be able to adapt and, march forward. But you look back at that graph that we showed, Jake, of the large companies over the decades, and they change.
Yeah, they do.
So the point is that you have to be willing to adapt and adjust and be humble and just be a constant learner. Because I remember when we first started having computers, there were clients of mine that says, I'm just not going to do the computer thing. My mom was kind of like that. And there's people that say, I'm not going to worry about AI. Well, it's going to be here, and if you don't stay on top of it, you're going to fall behind. So as far as the volatility of AI, I think that, yeah, when you have the tech stocks, 40% of the index, technology stocks have typically been very volatile compared to an industrial stock. And I don't think that that's going to change. So I think we could expect more volatility. How about you, Jake? What are your thoughts?
I agree with you there. I think maybe the only thing I would add to it as well is if you're investing in an index fund, let's say the S&P 500, you have to realize that your exposure to AI stocks and even to semiconductors, it's high on a percentage basis, right? Like we look at the top
Right.
10, you got Nvidia, you got Broadcom, you got a lot of these names. However, if you're only investing in the S&P 500 index, you're not getting a very diverse set of companies that you have meaningful exposure to. Sort of apart from those top names within the index, and you don't even have any international companies that are really intertwined within the manufacturing of these semiconductors like ASML and Taiwan Semiconductor. You are sort of concentrated into just a few names, and you've sort of been relying on those companies to drive a vast majority of the returns of that overall index. So I think that's where we see some concern there. Just there's not a lot of breadth or number of companies that you're getting meaningful exposure to. And if those names start to have fluctuations, you'll really feel that impact on a portfolio that's just sort of like the index is right now.
The other thing I would warn people about is the numbers are so much bigger now. So I remember, when the first month that I got my license and I went through training was October of 1987. And that was the month in which we had Black Monday, and the market went down. I just looked it up, 22.6%. It was down 500 points, which just seemed like, and people were literally committing suicide. It was horrible and a pretty bad month to start your career. If that
Yeah.
happened today, we would have the drop, in the market of 10,000 points in a single day.
Wow.
And I think that the numbers are going to cause people's jaws to drop. We're just at a higher level, so the percentages are more.
Right.
So, and we've also had a situation where so many people We've just had, four consecutive, is it 3 or 4 years now? We've had double-digit positive returns. That's unusual, and yet here we are. And I think there's a good probability we have another year like that this year. That's our base case. So
Yeah, so
moving
Scott, let's
along.
get to the next question, which is kind of away from our base case, although we've talked about it in this webinar a good bit about preparing for sort of the jolts or the volatility. And so the question is, how do we protect our investments from those jolts? Why don't you start and I can chime in as well.
Yeah, the whole theme in planning is to plan before there's problems. As you say, steer into the swell. The problem is sometimes you can't see the swells. I mean, I did not see 9/11 come, no, nor did you. And events that like right now, who knows what's going to happen in Iran? I mean,
Yeah.
we have no clue. We're kind of going through this saying, hey, it's going to be surgical. It's going to be like it was in Venezuela. But what if Iran sinks a battleship or aircraft carrier? I mean, it's not impossible, and it would be completely out of the blue and unexpected. But war is like that. It can go bad, and yet the markets are kind of ignoring it. So that's the kind of thing that believe me, I'm not predicting it. I have no idea, but it's just the kind of thing where the possibility isn't zero and the consequences are enormous. But if you reacted to every one of those consequential possible rare events, you'd never make any money because you'd be paralyzed. So the only thing you can do is to look at your personal situation and say, okay, if things go bad for 7 years or 5 years, do I have enough money to survive and thrive? What you don't want to do is in the middle of a storm, go out and check your belongings. You don't want to walk outside in the middle of the storm. And markets, my experience is sometimes markets don't function and people aren't rational. And unless you're going in with a strategy to buy, that's not the time to prepare for the storm. You want to do it ahead of time. And the problem is, Bob Harrigan or some newsman isn't telling you, hey, it's coming in 2 weeks. So make sure you've got always, always, always enough money to survive the 5 to 7 years without ever being forced to sell. And so that's, one thing that I wanted to, someone commented on gold. You want something that generates cash flow so that you have those funds to spend, which again will supplement your needs and you won't be forced to sell. So you can't really prepare for a jolt. I mean, you can do some things around the edges, carry a little extra cash, have a little higher bond allocation. But if you're wrong, you've got those funds underperforming for 5, 6, 7 years. So I hate to say it. I don't know if there's a magic pill that will allow us to keep all the upside and yet jump off that crashing plane right before it hits the ground. I've only seen Wile E. Coyote do that on Roadrunner.
Yeah, I think Scott, it's sort of part of our investment process though, right? Is to build portfolios to be resilient as much as we can, right? I mean, the only way to experience no risk, right, is to leave your money all in cash. And even then, your risk of beating inflation, right? That's your largest risk. And so overall, to have financial plans succeed, right, we need to have growth and we need to beat inflation. What we do in constructing a bond ladder of high quality municipalities, right, where we're very confident you're going to get your principal and your interest payments. And then also pairing the stock selection of very high quality dividend companies. You mentioned cash flow, Scott, and it's so crucial. I mean, even during COVID, even amidst an enormous amount of uncertainty that nobody saw coming, our companies still grew their dividends, right? And so you can count on that cash flow and the growing income stream there based on the type of company, the type of profile that we're looking for. And so I think it depends on your time horizon, for sort of the younger folk who have a lot longer to go. You're sort of looking at those jolts as, hey, let's get some cash to work and let's buy some more. And if you're sort of a little bit more later on in your track there, and you're in a, taking the income and using that, you really want a profile of company like is kind of our bread and butter, the one that's very defensive, doesn't fall typically as much as the market does, and then a strong ballast that comes from bonds and also cash flow generating alternative investments as well.
Yeah, the thing that's nerve-wracking is, and Nassim Taleb talks about this. We all want to manage our world and manage the economy so that it's just like a smooth ride. And what can happen, think of it like a forest. You need to have small fires all the time to get rid of the scrub. If the scrub gets built up, when you have that lightning strike, it can take it down. And so a lot of things that are happening now is with this deglobalization, we're starting to see countries kind of isolate themselves a little bit. In the 2007, 2008 crisis, you had all of the Western democracies really take a hit, and China really didn't, because their economy was functioning on a different level. And we're starting to get some of those diverse pistons going again, which will, like England, not, with Brexit, is separating themselves. Again, I'm not saying it's good or bad, but that does kind of, it's like a ship with different holes that you can, kind of cordon off. So I think that's a positive thing. The other thing I'd comment about jolts is in 2007, 2008, they had these credit default swaps. And we read these stories of hedge fund people that saw this coming, and they bet against the U.S. housing market that it would be this collapse. And what they had is they had these financially engineered products that were very opaque and nobody knew and could see. And then when that stumbled, it was a shock, and it started to take down the banking system, and the Federal Reserve and whatnot had to step in to fix the pipes. And so we're always scanning the horizon and saying, is there any area where we see those types of risks being built up? And we went through our tsunamis that we see, and one that we didn't put on there was, the debts, the deficits, private credit, and how much debt there is out there, kind of generally speaking. One of the questions we got was about gold, and basically there's a thinking with several different groups that are driving the price of gold up. There's one group that's the debasement group. They're the ones that are kind of thinking, not necessarily conspiracy, but that the world is printing money, and there's the amount of goods and services is growing at this clip, but the money supply is growing at that clip, and that's inflation, and it's going to cause some country to devalue their currency. And there's actually been folks talking about the U.S. doing that. They're not. It's nowhere close. There's no one close to becoming the global currency for the U.S. But there's a group of people out there that they buy two assets. They buy crypto and they buy gold and precious metals as a hedge against the dollar, and to try to get their money protected. There's another group that's thinking to themselves, okay, I'm a big government. I'm China or India, and I don't want to have all of my reserves in the US dollar, especially if we think the dollar is going to go down. So where can we put our reserves? And they're all crowding into this trade on gold. And so gold has gone up 400%, in the last 5 years. I've never seen it perform that way. My bias is kind of like Warren Buffett's, where he says, I don't understand gold. This is Buffett's quote, not mine. You pay somebody to dig something out of the ground, then you pay somebody to ship it, then you pay somebody to bury it underground, and you pay somebody to stand guard over it. And it doesn't create any value. An ounce of gold in George Washington's time would buy a fine men's suit. An ounce of gold today would do maybe a suit and a half. It's really not an asset that you're going to build long-term wealth in. It's an asset that can protect in a real global catastrophe, perhaps, but it hasn't always done that. It didn't really protect you. It might have done a little bit in the 2008 crisis. And it certainly is doing well now. So if you've got gold, congratulations. It just has never been part of what we think builds and maintains long-term wealth. We'd rather be in a company like Florida Power and Light, where we know come hell or high water, you're going to pay your electric bill next month because you need electricity. You're going to pay your water bill. You're going to go to Walmart. Those are the companies that can surf the wave of inflation. Jake?
Yeah, well said, Scott. We ran over a little bit today, so again, thanks for the questions to all our clients here. Thank you so much for tuning in. Scott, any final words?
We got a couple of other comments. What are the best sources to learn about AI? Man, we've got so much on that. Boy, I see who asked that question. We'll get back with you and we'll put that in our post. But we're learning about it every day. And the applications, I think there's a podcast now that I've heard that is about the new applications of AI, and it will blow your mind. It really will. And it's scary, but it just kind of have to trust it and know that it's working out. The other area, so I'll wrap up. I could talk forever about what we see going on in the market, but I do appreciate it. And by the way, our thinking on this is that coffee with forethought. We know that there's a demand for short form video, but there's a demand also. You can look at what's popular with people for long form video, and that's what this is designed to do. So quarterly, we're going to have a longer, more relaxed conversation about what we see going on and allow you to ask questions. So. And we'd also love to hear from you if you like this format where we have all the questions at the end, or whether we have it more live. So that's another change that we've made. So with that, God bless. Appreciate everybody, and have a good night. Call us if we can help you. And remember, great planning requires forethought.
All righty, take care.